We talk about this all the time. There's a big move this morning. We open up. All right. We open up, and there's always people that are bullish and embarrassed, but we open up and immediately rally 20 points from '09 to like 30. And then we start coming down and we go through what usually is great support. As soon as we did that, I said, that's a B to B, bullish to bearish moment. And we really had extended downside after that. Remained bullish. I'm sorry, remained bearish for another 60 points to the downside. The reason why, when you get this context, you open up and you jump, you get all the fools that just get bullish because of that. It's different if you're bullish for other reasons and you're playing support and maybe it's working. But when you're just bullish because it jumped 20 points, you didn't even catch it, and that's the only reason why you think it's going to go up all day, that's the bait. So when you have that context where you kind of create the teeter totter, now there's this imbalance. If this is a teeter totter, you have an imbalance of people who are bullish. And when you get more people who are bullish, then generally you're going to get more people long. When you get more people long, you have more what? Sellers. What does it take to make the price of anything go down? More sellers. So more longs, because you got everybody bullish with this example of opening up and rallying. You just have to know that that was like a perfect storm and trap. Now, when people have trouble understanding how bearish it is, everybody likes to pick a bottom, and it's just like it's your anxiety. It's like you missed the downside. You missed selling it at 90 and buying it at 10. So you want to buy it at 10 and sell it at 90. That's how the mind works. We didn't do this. You feel bad about that. But if I could do this, I could feel good again. That's dangerous, because when the market doesn't give a shit about your opinion, it's just going to continue to run you over. And like I said, you take a fading strategy and turn it into a fighting strategy. Now, we have these PWAPs. When you see green PWAPs diverge on the selling on downside, that's potentially a bottom. Let me explain. If you take a look at the upper left chart, I'm going to say after the fact that sure, this was the bottom down in here, the best bounce that we had on this particular session. But there's also a precursor to that. If I back it up, I want you to look at this green line, this green dotted line here, and this red dotted line here. Watch how they diverge, which means one goes up, one goes down. And I'm going to back it up. You start seeing that diverge right here. Red's going down, green's not. And then all of a sudden, green's going up, red's still going down. Let me back it up, because it doesn't matter unless it's in the early stages of the bounce, right? You could start saying that right in here. Red goes down, green doesn't. Green goes up, red still goes down. What that's telling you is that there are more shorts coming in, selling it, but really not enough longs. It's not commensurate with the amount of longs. There's no balance with respect to open positions. So when you have more shorts, remember this, more shorts, and we could do the algebra with MS, equal more buyers. If you're short, you're a buyer. If there are too many shorts, there's too many buyers. If there's too many buyers, the price of anything goes up. And that's what highlighted this area as a chance to rally. That's all. And so it helps you from getting stuck in the hole, getting short, and being too late. And then look at this pop. And it all started with the idea of more shorts, that's the red going down, and less longs. When the green dotted line starts going up, that's less longs. Less longs equal what? Less, what does it equal? Less longs equal less sellers. What's not just helpful but imperative for the price of anything to go up? Less sellers. Can't have a lot of sellers. How's the price going to go up? So you get the combination of less longs and more shorts. More shorts, remember, equal more buyers, right? So you get this combination of more shorts and less longs. This is what you need for the price of anything to go up. And if you're going to sharpen your predictive skills, stop looking for buyers and sellers and start looking for longs and shorts. You're trying to predict buyers and sellers. Doesn't do you really much good to tell me they're buyers and sellers when everybody in the world could see that there's buyers and sellers. We're trying to predict where future buyers and where future sellers are going to come in. And when there's an imbalance of buyers to sellers, then your opinion of being bullish or thinking it's going to go up is going to be better. It's going to be highly probable. You're going to be right more. Your locations are going to be better. So I think people get in and they when they get into trading, especially day trading, they try to predict the wrong stuff.